Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of finance. And in this episode, I'd like to talk about how to invest in property if your budget is less than $1 million. Now, of course, $1 million is a lot of money, there's no doubt about that, but it's becoming increasingly difficult to buy a investment grade house in either Sydney, Melbourne or Brisbane for less than $1 million. So with that being the case, where do you invest if your budget can't stretch to that point that allows you to buy a house? Well, firstly, let me say that I'm still very optimistic about the Brisbane market. It is still possible, I think, to buy an investment grade house in Brisbane. How long that persists for, I'm really not sure about. But if you're interested, there's a podcast I did in August 2021 where I shared my, investment case for buying an investment grade property in Brisbane. And I'm pleased to say I put my money where my mouth is. My wife and I settled on an investment property in Brisbane last month. So I eat my own cooking, which I think is sort of important to point out. So I'm still bullish about that market, but it is very challenging. And there's two challenges, by the way. The first one is, obviously price point challenges. And then the second challenge is buyer's agents. Buyer's agents in Brisbane are so busy that they and you can imagine a lot of buyers are really in that, say, $700,000 to $1 million mark. So it's very crowded. So getting a buyer's agent to represent you in this market is also very challenging just because they're so busy. Now, of course, I probably don't even need to say it, but if you think about Melbourne and Sydney and the cost of an investment grade house in those capital cities, you're going to need well more than $1 million, probably north of 1.3 in Melbourne. And approaching 2 million and beyond in Sydney, so not even close. Now, of course, it's possible to find houses in those capital cities that you can purchase for less than $1 million, except those properties tend to be in non-investment grade locations or have completely unacceptable compromises. So that is, they're not really deemed to be investment grade. And remember, there's never a good reason to invest in a sub-quality standard asset. And in fact, your long-term returns will be directly related to the quality of your investment asset. That's true with property and really any sort of investment because you cannot expect good quality returns from an average or poor quality asset. They're going to be commensurate with asset quality. So if I was faced with the decision to buy an impaired house or a investment grade apartment, I'm going to go investment grade apartment every day of the week because it's really about quality and less so that's the number one concern. And then whether it's a house, a villa unit or a apartment is secondary to quality. And that's actually a good segue to talking about villa units. So villa units, just let me describe what I'm talking about here. It's normally sometimes they're called flats, normally small houses that share the same block of land. So there might be 3 on the block. They tend to be single-level homes, typically constructed in the 1960s or thereafter, say between 1960s and 1980s, sort of in that range. Typically, the owners have some shared amenities. Often it's just restricted to a shared driveway. But sometimes can be, courtyards and those sorts of things. But essentially, each individual owner has an interest in and control of their own parcel of land, their own portion of land within that block. Now, you will find that villa units tend to be quite prevalent in impaired locations, such as busy main roads or sort of secondary suburbs, a little bit further out. But it is possible to also find them in investment grade locations, in sort of blue chip suburbs, but you must select them very carefully. Villa units are a scarce asset, which is good for capital growth. And the reason they're a scarce asset is because they're really not economical for property developers to build anymore. If a property developer is considering, as a block of land in a very valuable location, they're probably going to build 20 apartments rather than 3 villa units. And so for that reason, they tend to be quite land value heavy, and that makes them a good investment. And then they're scarce, which also, again, makes them a good investment. It's possible to buy a villa unit in Melbourne for around $1 million, maybe 900 to 1.1, sort of that might be your range, again, in an investment grade location. It's not possible to do that in Sydney, of course. And villa units aren't that common in established suburbs in Brisbane. They tend to really have houses or a block of apartments, but the same principles apply in that Brisbane market. So if your budget is less than $900,000 then what do you do? Well, my view is that investment grade apartments in Melbourne represent the best value opportunity for property investors, and have the fundamentals that exhibit potentially the best growth prospects, not only longer term, but certainly over the shorter to medium term. I published a report on investment grade apartments in October 2020, which is available on the website, and I've taken the opportunity to update that report. My update is included in section 1 of that report. I've included as an addendum, and you can download a copy. A link will be in the show notes and obviously on the blog on the website, so you can certainly take a look at that, which sort of outlines my rationale or confirms my rationale that I wrote back in October 2020, and then adds to it and updates some of that information as well. But I guess I can present the investment case by highlighting 3 positives or 3 attributes of why I think investment grade apartments are the best option if you have less than $900,000 to invest, and I should say investment grade apartments in Melbourne. Okay, so the first one is that apartments have never been cheaper in Melbourne relative to the cost of houses. So what I did is I've charted the relative cost of houses versus apartments since 1980, and it's an all-time high. So at the moment, the median house value is 1.45 times the median apartment value. And that's certainly the highest it's been on record, which sort of suggests potentially that, either houses are overvalued or apartments are undervalued, and it could be, of course, both those things. So as I said, currently houses are worth 1.45 times what apartments are worth. And if we have a look back in history, from 1980 through to 2005, that 25-year period, the average was around 1.3 times. And then it dropped down to 1.2 times between 05 and 2013, mainly driven by the strength of the apartment market. And then now, obviously, we've had really since 2013, houses have done incredibly well in terms of price performance. At the same time, apartments have done poorly. And so the ratios widen out to 1.4 times. So we should ask ourselves, is relative value a good predictor of future returns? Well, there's 2 times we can look at where the market has peaked previously, less than what it is currently, but it peaked in 1989 and then again in 1998. So in 1989, it was 1.38 times. So still quite high, but not as high as it is today. And if we have a look at subsequent growth after the 5 years after 1989, apartments only grew by 3%, and houses at that same time over that same period grew by 2.3%, so less growth. But if we think about that period, 1989 through to 1994, we had the recession that we had to have, as it was coined at the time. So it's probably not a useful indicator when, it was really Australia's last real recession. I guess we had a technical recession last year, but real recession. So let's look to then 1998, when again the ratio peaked to 1.35 times. So again, at the moment it's 1.45, so 1.35 in 1998. The subsequent 5-year growth at that time was apartments grew by 14.9%. So it suggests that potentially relative value could be a reasonable indicator of future returns. And that probably stands to reason. So if you think about the logic of it then, if houses are a lot more expensive than apartments, then really if I want to go and buy in an investment grade location, maybe 10 years ago I could afford either a house or an apartment. I could make that decision. However, if houses are a lot more expensive today, those buyers that used to buy a house might be forced back into that apartment market. So either got to do that or compromise on location, go further out. And there's a large cohort of people who just don't want to make that compromise, and they'll just have to make friends with, buying a 2-bedroom apartment as opposed to a 2-bedroom house. And so that means that the proportion of buyers, a greater proportion of buyers, will be looking at the apartment market rather than the house market. So it makes sense that when houses are relatively expensive, apartments are probably going to perform better over in the shorter to sort of medium term. That leads me nicely into my second point. And my second point is that the best time to invest in a market is after a period of poor returns. Now, assuming you're investing into established market and you're using a rules-based approach, so you're buying a quality asset, the best time to buy into that market is after a period of poor returns. And the reason for that is mean reversion. And it's an irrefutable fact that established markets eventually revert to their mean return, so their average return. That means that a period of below average growth is typically followed by a period of above average growth. And given that property cycles tend to last around 7 to 10 years, and I've observed that previously in my work, given we're already sort of 10 years into this cycle of very low growth, 3.7% over the last 10 years in investment grade apartment, or just the apartment market, I should say, in Melbourne, then as each year passes, the probability of us entering into the next growth cycle becomes higher and higher and higher. And also, the longer the period of below average growth, the more substantial the return. So by letting mean reversion do all the heavy lifting, you're investing in a market that is primed for growth, that has a lot of pent up demand and so forth. If you look at the average growth between 1980 and 2011, so 10 years up to 10 years ago, the average growth in investment grade apartments was 9%. That's pretty substantial, and it does demonstrate that they do have the capacity to be able to drive a lot of capital growth. But really, the last 10 years, as I said, has been 3.7%, so well below the average. Now, the inflation rate was higher over that period of time, that 9%, so maybe that's really 6.5% of real growth, 6.5% plus inflation, but still, it's a considerable return. Now, it's not always easy to invest in markets after a period of very low growth. In fact, it's sort of contrary to your gut feelings or your gut instinct. To some degree, it feels a lot safer to invest in markets that have recently produced really good returns because it feels a bit safe. You just don't know why would you invest in something now when it's only given me 3.7% return over the last 10 years? So, of course, it doesn't feel like an obvious thing to do, and you really do need to trust in the fundamentals, take a long-term view, and really rely on that mean reversion coming through. It will. That's without a doubt. I think it's just the timing of when that will occur is probably the unknown factor. But as I said, as each year passes, as we get deeper into an extended period of very little returns, then we get much, much closer to a market. And I guess a better market. And I guess that was the observation recently in Perth. Up in Perth market has been doing really well over the last 18 months, 2 years. But the previous 10 years to that, it really was a really horrible and tough property market. And then as each year was going by, I was thinking, well, when's Perth going to kick off? and it eventually did, but no one knows when that's going to happen. Okay, and my last point, my last reason why I think investment-grade apartments in Melbourne represent the best value opportunity for property investors with a budget of less than $900,000 is the supply side story. So in my report in October 2020, I sort of talked about, the impact of supply of new apartments in Melbourne having a great impact on their returns and the return and growth of established apartment property prices, right? There was a massive influx of supply, and of course then it affected prices. Well, for the same reasons, I think supply is going to drive growth. So if we have a look at apartment supply in Melbourne, let's look at the average this year. It's averaging about 8,700 apartments as an annualised figure in 2021. That's the sort of, the new apartments that have been approved. That level hasn't been seen since 2010, but we have to be cognizant that in 2010, there was 1 million less people in Melbourne at the time. So on a per capita basis, you could argue that apartment supply has never been lower. Maybe in the 80s, but certainly not since then. And there's a big pipeline, there's a lead time, I should say, when apartment gets approved versus when it gets sold versus when it gets occupied. So it's going to be a big ship to turn. So we're probably going to enter into a period of very, very tight supply. And that should underpin prices and hopefully push them higher. And even if developers turn around tomorrow and think, okay, let's go and build a whole bunch of apartments, there's a 1 to 2 year lead time. So we're at least got a market of very tight supply for the next couple of years and possibly longer. So just to remind you, in terms of those three things that I think, three factors or observations or viewpoints maybe. Firstly, apartments have never been cheaper relative to houses in Melbourne. The second reason was that mean reversion will do all the heavy lifting, that the average returns over the past 10 years have been well below the long-term average returns, and then a much tighter supply. In fact, very few apartments are planned to be constructed in Melbourne over the next period of time. So I think those three factors will lead to arguably, or what I would expect, pretty good price growth over the next 5 years. When that growth cycle will begin is obviously less certain. Of course, I've put more detail around this in the report that I prepared, so feel free to go and download and have a look at that. And I think particularly if you already own an investment-grade apartment in Melbourne, or if you intend to purchase one. So let me leave you then with some indicative ranges, in terms of budgets in regards to investing. So if you had a budget of, say, $500,000 to $700,000, I would suggest that look for a one-bedroom investment-grade apartment in Melbourne. That's kind of your range. If you've got less than $500,000, you're probably going to struggle to really get into that investment-grade market. If you have $700,000 to $900,000, then you should look at a two-bedder. Now, one of the questions I might get, Stuart, if you've got $650,000, $700,000, why shouldn't I buy a two-bedder with that money? Well, because I think you're going to get a better quality, a higher quality one-bedder for that price. I think you're spreading your money too thinly, and then going to compromise on quality if you try and get a two-bedder for it. At the end of the day, what you're looking for is the attributable underlying land value in that apartment. Certainly bedrooms will have an impact on growth and value and so forth, but quality trumps that every day of the week. And lastly, if you have $900,000 to $1 million, then I think I'd be thinking about a villa-style unit in an investment-grade location. Now, just to leave you, I know I bang on about this all the time, but asset selection is absolutely key. So buying the right asset is fundamental to making property investing work. And so if you're going to go down that track, I always encourage and counsel people to get quality advice. That is a really good quality, experienced, local area expert buyer's agent to help you select the right asset. And most importantly, avoid making a mistake, avoid investing in the wrong asset. Okay, that's it for me for this week. Thank you very much for rating and sharing the podcast. It certainly helps a lot with its listens and so forth. And until next week, bye for now.